Hey YouTube, welcome to the Subprime to Prime YouTube channel. Here, our focus is to get you from subprime to prime, and that all starts with knowing where you want to go on your financial journey. If you're new here, welcome. We appreciate you coming out, and please give us a like and a subscribe if you like the information inside. So here we go. We're going to get started with this. Now, in this video, I'm going to explain to you the concept of infinite banking, and it's called the infinite banking concept. It's a financial strategy that focuses on using whole life insurance as a personal banking system. Now, this approach was popularized by a gentleman by the name of Nelson Nash in his book Becoming Your Own Banker. And the idea behind IBC is to grow your wealth through life insurance policies that have cash value. And I know if you've never really, heard of this concept before, it's incredible. So, the concept is, outside of the box thinking, but basically you're going to borrow against, your life insurance policy rather than from traditional banks and other financial institutions. And then here's the breakdown kind of how that works. So a whole life insurance policy is a policy that insures you for your entire life. So as long as your premiums are paid, you have this from when you initially begin the policy all the way up until death. And unlike term life insurance, which it's a temporary set amount of time that you purchase that for. So let's say some policies have a 20-year, 30-year, or 40-year or so life policy, and you eventually age out of it if you survive the entire time that you're insured through the policy. So with a whole life policy, it grows in cash value. Over time, the cash value grows tax deferred and at a guaranteed rate of return. So the potential for dividends is there. Now, this growth is slower at first due to the cost of insurance and fees, but accelerates in the later years. So borrowing against cash value, once the cash value is accumulated, you can borrow against it for any purpose, such as investing, buying a car, buying real estate. And the beauty of the system is that you essentially are borrowing from yourself. And then the loan interest rates are typically lower than those of banks. And then plus, the policy continues to earn interest and dividends for the full amount of the cash value. So even on the portion that you borrowed, once you've borrowed it, it still accumulates interest as if though you've never taken it out. That's the beauty of borrowing from your life insurance policy. It still accrues interest, even though, let's say you have a policy that's built up cash value of say $25,000. And you want to borrow $5,000, for let's say something easy, something like a major home repair or something like that. Now you would borrow that $5,000, but inside of the policy, it's like the $5,000 never left. Now you'll pay yourself back in the form of interest or additional interest. And that money's tax-free. It's not, you don't have to pay any extra fees on top of just paying back the money plus the interest. And like I said earlier, it's often at a way lower interest rate than borrowing from a traditional bank. So while you're encouraged to repay the loan and maintain the growth of the cash value, the repayment terms can be more flexible than those of a bank. So if the loan is not repaid, the amount deducted from the death benefit is deducted from the death benefit should you pass away during the time you borrowed. Now, there's also a caveat that you do have to pay it back, because sometimes the interest that accrues could potentially get bigger than the amount that you had in there, and that would cause a lapse in the policy, which means you forego the entire policy if you let it lapse. So staying on top of it and repaying back the loan is key, because you can continue to borrow from it over and over and over again, which is amazing. So the key considerations is the starting capital. Like I said at the beginning, it starts off fairly slow because of the basic cost of insurance and everything. But you would purchase what they call paid up additions. So each year there's a maximum amount that you can add to that pot each year that will give you a cap of earnings that you can have inside that policy. And once you reach it, it just grows exponentially because interest is accruing constantly. And you get to the point where compound interest is working for you rather than against you when you borrow from a traditional bank and get a loan or whatnot. And that way, as it grows and you accelerate that growth, you can begin to buy all kinds of things, i.e. homes or real estate, cars, loans for a myriad of different things. And it's an exceptional way to not have to worry about whether or not you qualify or that your credit's at a certain level. This way you can borrow from yourself and pay yourself and treat your own policy as if though it is a bank. And so you can get a multiple different policies for different things. Let's say you only want one in case you want a car every few years or something like that. Though I don't recommend buying things of depreciating value, but just saying, if that was something you want to do, you can have a policy that's just for that. You can have a policy that's just to purchase real estate, and so on and so forth. So it's an excellent long-term strategy where you don't always have to, have approvals to get it, and it is yours, and it's a death benefit should you or not outlive your policy. So it's just one of those things that I think is an excellent tool to help you along in your financial journey. And for more tips and information, please give us a like and subscribe, and hop over to our VIP school platform, Subprime to Prime, to get more information on all things financial literacy. Thanks so much, and have a good one. We'll see you next time.